This video is going to be a follow-up to a recent video I put out called Watch Me Buy Our Next Investment Property. If you haven't seen it, make sure you click the card. It's somewhere over here, and go back and watch that video before I break down the numbers today. We're going to be doing a few things. We're going to be running through a calculator of the current cash flows expected for our most recent investment purchase. We're going to be talking about the native gearing and what that might do in terms of our property portfolio. And then we're also going to run some exciting numbers. We're going to look at whether we build a granny flat on the property or whether we subdivide and build a dual occupancy on the back of this property in the next 12 to 24 months. So if you're interested in this type of content, make sure you subscribe to the channel down below and drop a like on this video, and let's dive straight into it. So a quick little recap, we purchased 28 Bramble Road in Shayla Park recently to build out our asset base to around $7.5 million. Now the big reason we purchased this block is, as you can see on screen, 1,012 square meters of prime land with the house very positioned towards the front, wide drivable side access, and really clean flat backyard. This is located in Shayla Park on the south side of Brisbane, roughly 25 to 30 kilometers south from the city, essentially between Brisbane and the Gold Coast. And this is in Logan City Council, which is actually where I grew up. I grew up in Logan City Council, so I know the areas very well. And this leaves us with currently 4 houses in Southeast Queensland in our own property portfolio. We've got a house 2 kilometers north of the city, which is the first property we purchased. We've got a house on the north side of Brisbane, which will be a renovation series coming soon called the Bray Park Bomb. And if you want to get some sneak peeks, head over to my Instagram and follow me there, and you'll get some updates around the Bray Park Bomb a lot sooner than YouTube does. And we've got this property on the south side of Brisbane in Shayla Park that we're going through today. And then we've got our own home in Greenslopes, which we've done that raise and build project. And we're going to be bringing out that renovation series really soon called Growing Gables. And I can't wait to bring it to you. We've put so much work, especially my wife, Emily. She's done some amazing video editing and some amazing work on that renovation series. And so there's going to be a big push in the next month to release that series and promote it out here on YouTube. But that's not what we're talking about today. We are talking about this property here, which is 28 Bramble Road in Shayla Park. We're going to download my free property investment calculator from my website, and we're going to run through the numbers today, and then run through the granny flat, and then run through the subdivision potential numbers. So if you head over to my website at purposeproperty.com.au, you can download this calculator for yourself. And it's just a little basic template to help you run your numbers, and it might be useful to you, it might not. But what we're going to do in real time is update this spreadsheet and go through the numbers on this latest deal that Emily and I have purchased. So the property address is 28 Bramble Road, Shayla Park. The block is 1,012 square meters. It's a 3-bed, 1-bath home with 2 car spaces outside essentially. And we can find the taxable land value by going to Google and looking up the taxable land value from the Queensland government. So if you just type in here, taxable land value Queensland, it's actually the second link here. So if you go to the Queensland government website and search for your land valuation, you can see here that the land is currently valued at $445,000. But this valuation was done in 2022, and it confirms the block size and the property lot number and the RP number there as well. This is really useful for your land tax planning. So you can have a look at what the land value currently is. Now, this is not a reflection of the market value of the land today, which is probably around $650,000, because that land value was done for 2022 and they're always behind in terms of the property. Now, I've done my flood checks and I know the property is not flood prone, but it does have granny flat potential. So now let's run through some deal analysis numbers and work out what this purchase looks like in terms of rough numbers for the deal. So we purchased the property for $855,000. So you punch that in the calculator. My solicitor's fees were about $1,200 excluding property searches, but including searches were about $1,600. Now I've written a little formula here for stamp duty, but make sure you double check it because when I wrote that formula, it was about 2 years ago. So just double check that is the right number for stamp duty. We had some basic inspections. You might have a building and pest, some other mortgage and title fees. you can add in extra costs as you see fit. So in this example, we're saying that the property cost us around $889,200. So that's the purchase price, solicitor's fees, stamp duty, building and pests, some mortgage and title registration fees. So we're at $889K. We're actually not going to do any initial renovations, and so the total funds required is $889K. Now we need to work out what the home loan amount is in this case and how much money we are contributing. So you can see here we're going to do a 20% deposit in this case. And so 20% of the purchase price is $171,000. We also need to pay out of pocket those other costs. So the solicitors, the stamp duty, your pre-purchase are all going to need to be out of pocket. And so that totals to $34,200, which means that we're getting finance of 80% of the purchase price, which should leave us with $684,000. Now the interest rate I've got here is actually 6.5, but would you believe I'll be paying something like 7.74%. And you might be going, Luke, why on earth are you paying close to 8% on this property? You're purchasing it for 855 grand. We haven't even run through the weekly income yet, but that is going to be negatively geared for a freestanding bread and butter property, a freestanding single income dwelling. The answer is yes, that's true, but I like to look at my property portfolio on a weighted average interest rate. So some of my rates, on my own home might be 6%. Some of my investments might be 6.5, 6.8. And then this property is at 7.7% because we're going with a third tier lender called Better Choice. And we're expanding our borrowing capacity by going with these lenders. Now, you need to be aware of the risk of doing that. But in my personal strategy, we generally take out a 1 to 2 year interest only period. We look to add value to the property. So I'm looking at a subdivision or granny flat in this case. And we're using these lenders as stepping stones to then refinance back to the big banks down the track. The reason being is the big bank serviceability buffers are a lot worse when you don't own the property, when you're looking to make the purchase. But when you're refinancing, a lot of the big banks will use a 1% buffer. And that's where you can jump from a second to third tier bank back to a first tier bank after 12 to 24 months. And that's exactly what Emily and I did in our property journey when we bought Coffs Harbour. We used Pepper Money, which is a big third tier lender here in Australia, to buy the Coffs Harbour unit block. We were then able to refinance that unit block 18 months later back to the Commonwealth Bank of Australia because we went through that process of the market increasing. We did some renovations and added a bit of value, and CBA had lower buffer requirements to bring the property back across once we owned the asset. So diving back into our calculator here, you can see that we've got our purchasing costs broken down, so $889K in total. We've got our debt here at $684,000 at a 7.74 interest rate. We can put in a revaluation if we want to do some work. This is for generally when you're doing a renovation, but we're not largely doing a renovation in this circumstance. And then you can look at refinancing on 80% and what kind of cash out that will give you. So if we got a valuation at $950,000 and we were then able to obtain new debt of $760,000, that would leave us with cash out post the renovation of say 76 grand if we were increasing the value. Or if the market did that lifting and we didn't do any renovations, you would just get 76 grand out if you're able to refinance that property at a higher value in the future. And so that kind of summarizes the deal analysis. So we've gone through the purchasing, we've gone through the cash outlay. So we're going to need to outlay $205,000 of cash, which is coming from equity that we've refinanced recently out of our other properties. And then we're funding the deal with $684,000 at a 7.74% interest rate. Now, the weekly rental return on this property is going to be somewhere between $600 to $650 per week. We're expecting a vacancy of 2 weeks per year, which is a 96% occupancy rate. This totals to $32,500 a year in terms of income. And so what we are wanting to work out here is what happens if we've got this income and we've got the associated interest expenses and other costs on the property. How negatively geared is it? So you can go through and say, oh, there's cost to advertise, there's council rates, there's insurance, interest on the loans. I've got my property manager. Let's say my property manager in my case is 8.8%. So it's costing me $2,860 a year for my property manager. I've got $1,000 repairs and maintenance budget, and maybe I'm getting charged the connection for the water. So income's $32,500 a year. Outgoings are $60,000 a year, or $1,100 a week. What this means is when we look at the net yields, is that we're going backwards about 3.2% a year, or close to $30,000, $27,552 a year, which is costing me, this property is costing me before tax benefits, $530 a week. That is a lot of money. $530 a week is a lot of money to stomach, but in my property portfolio, this asset is deliberately negatively geared. The reason being is when we purchase this property, we are purchasing this one in personal names versus other ones in trust structures. And the trust structures we're looking to have positively geared from the get-go, and this one being negatively geared for 1 to 2 years before we add the other dwellings is okay, because when we potentially subdivide, we'll be able to have separate titles and different titles on those different addresses. Or if we add a granny flat, this will take that minus $500 per week to around about neutral. And that's the numbers we can run right now. So what we're gonna do is we're gonna unhide this section of granny flat, and we're gonna put in some numbers here around the granny flat cash flows. So some recent numbers that I've seen from clients and what we've been doing with clients in terms of building granny flats is somewhere between $200,000 to $250,000 to build a granny flat on these size blocks in these areas. So in my case, I'm gonna go with a bit of a premium granny flat, and I'm gonna spend $250,000 on the granny. Now, I think my granny will actually rent for a premium as well. I think it's gonna rent for $550 per week. This will give me 550 times 50 weeks in the year, which is $27,500 a year. Now, operating expenses. There are gonna be some operating expenses when you add the granny flat in, like management, fees, you know. They're still gonna have the higher rates. You're gonna have some higher maintenance, all those things. And so there's different ways you can do this, but you can make your own estimate as to what you think your own operating expenses will be. In this case, I could say it's fully debt funded or fully cash funded. That would make a massive difference. But let's just run the scenario that we're adding this granny flat with cash, and we're just adding in the other operating expenses, which would be all these other expenses here. So if you're adding in cash, you're not gonna have any interest bill, but you're gonna have management, you're gonna have, you know, all these other fees here. So let's just say it is $7,000. It mirrors the house and it costs you $7,000 a year in terms of operating expenses. This would leave you with a net return of $20,000 a year. And we look at the net yield on the build costs, which is about an 8% return on the build. So then you can look at the net annual cash flow, and all you need to do is add your net income to your net loss or your other net income, and there you go. So suspending and building a granny flat would turn the income into $7,052 a year out of pocket. If you divide that by 52, the property is costing you $135 a week to hold at that point. Now, this is with interest rates at 7.7% and 80% debt. What this means is the bank pretty much owns the bulk of this property. If the bank owns 80% of the property and it's at almost an 8% interest rate, the bank owns most of this property. But what I get to do is add value. So I can potentially add that granny flat. I can potentially boost the yield by renovating the front home. If the market increases in value, I get the reward of that. And so this property specifically in our portfolio is for coming back and adding this extra dwelling, or doing a new project, which we're going to run through the numbers in a second, and subdividing and getting 2 dwellings. And that will not only increase the cash flow, but potentially increase the equity as well. Now, if I scroll down, you can see that there's a tax effect accounting section here. I don't like to go through this on YouTube, but I like to provide it as a guide for people to do their own calculations. So you can look at, I think the tax brackets I've got over to the right are old. Let me just show you those. So I've got some old income tax brackets here that you can update yourself with current tax brackets that suit you. And you can also do, you know, some ownership splits. So do we own the property 50-50? How negatively geared is it? What are our incomes? And then what's the impact on our tax? So yeah, how does that impact our tax? But for today's purposes, I won't be running through the tax effect in detail. Again, because I don't want to get into tax law and going into that. But if it's useful to you, fantastic. If it's not, that's okay. You can just run the pre-tax numbers like I've run today, and then do your own tax effect based on your personal situation. So now I want to go through the thing I'm really excited about, which is subdividing the property and going out and building a dual occupancy on the back of the home. So what this means is we're going to subdivide the back of the property. If we go back to our original overview of the property and we look at the aerial shots, you can see here we've got the house and it's quite far forward on the block. We can fence off the front of the property, maybe where my cursor is here. We can then fence the back of the property and make this its own little block here. We can have a parking spot here with a carport, a small front yard, and a small backyard. You know, we might be able to fence it 3 meters from the back fence. From there, we've got wide drivable side access. The sewer is way off in the back corner here along the fence line. And so what that means is I'm looking to get about 600 square meters on the back block, including the easement or the driveway. And so if I can, from about the middle of this tree, cut across, put that fence through, and then claim all of this space as the back property, that's where I'm looking to build potentially a dual occupancy there down the track. Now, this may or may not be feasible, which is why I'm looking at the granny flat option as well. But let's run through the numbers, both from an equity point of view and from a build cost point of view, to see what the dual occupancy option looks like. So I've opened up another tab in my spreadsheet, and we're going to subdivide and create a dual occupancy. Now, one of the companies here in Brisbane that's quite popular is called Dixon Homes. And you can jump onto their website. They've got 80,000 designs, and they're a pretty straightforward builder. They use a steel frame, very process driven. They build a lot of homes here in Southeast Queensland. So you can get a rough house design, and you can look at their house and land packages for dual occupancies to see what the cost of a new property would be. So jumping here into Dixon Homes website and scrolling down, you can kind of see prices. These houses are in Collingwood Park. They give you a build size of the homes, about 180 square meters. And these are from 700K to buy these types of assets. So if you just jump in and have a look at some of their designs, you can also search and find different price ranges. So if we say we want a 5-bedroom, 3-bathroom, 2-car home, and we want the price low to high, we can then click search, and you can kind of see here that they're giving build square meter rates of 239 square meters, which is going to be about what we want to build. The land area is 1,016 square meters, and you're looking at a price of around 900K. Now in this case, this is the house and the land. So what you need to try and do is work out what the land's worth on a 1,000 square meter block in Nambour, for example, and then work out what the build price roughly is for this type of asset. Just to be, rough numbers, if we're looking at a 405 square meter block in Redland Bay, and the house is about 244 square meters, let's say, for argument's sake, the land is about $350,000. So our build cost at this point in time is going to be 900K less $350,000, which leaves us with a build price of about 550K, which is what I was expecting for a dual occupancy, with about 250 square meters, and that includes carports, concrete, the full fit out of that property, $550,000. Now, the rental yield, there are recent rental yields in this area in Shayla Park, and so I can tell you, with a house and a granny flat under one roof line, you're going to be getting close to $1,200 per week. So about $650 for the 3-bedroom side of the property, and then about $500 to $550 for the other side. Rough numbers, if you're getting $650 and $550, you're getting $1,200 a week times 50 weeks of the year, $60,000 a year on that 550K investment. Now, your operating expenses might be a little bit higher, so let's double it and say it's $14,000. This is where people want to argue over what the expenses should and shouldn't be. It's going to be different based on your circumstances. But again, we're building the property with cash. We're adding the dwelling with cash. And we're just running the property in terms of expenses. So the net income, this means the property's earned or paid outright. We're getting an 8.36 net yield on the property after operating expenses. And that will give you a net annual cash flow post the build of 46K plus the minus 27 that we had. And so that would be returning $19,000 positive cash flow per year, with 80% debt at 7.7% interest rate on the front house. Now, what we might do is also renovate the front house and try and increase that rent to $700 to $750 a week. The other big thing that this doesn't account for is that spending that 550K and subdividing is going to add significant value to the rear dwelling, because you're going to have titles on the front and back property. So you've got the front home and you've got the back home. You also might need to factor in around $50,000 to $70,000 for the subdivision and for the civil works. So, you could add that on top here if you wanted to, and that will give you a net return of 7.42%, and you're all in around $620,000 to do the subdivision, to build the dwelling, and you have both those properties let out with 14% operating expenses, giving you that 7.42% return. It doesn't change your yield, adding in that extra cost, and so This is where it gets really interesting, is when we start looking at the equity. So the front home, we've paid $855K for a 1,000 square meter block with a 3-bedroom, 1-bathroom home. If you look at this area, knocking off the back block and selling the front property, it might knock off about $100,000 to $150,000 off that front asset. So let's say that front home, it loses $150,000 worth of value by subdividing and taking off that back block. That means the front home's worth about $700K. Now the back home is going to be worth about $1.1 million. The reason I know that is there is recent sales around that 1.1 to 1.2 of dual occupancies on similar block sizes in this suburb. Now we might want to be conservative and say, okay, it's $1 million because it's a rear lot, it's a battle axe, but it's a brand new dwelling which costs $600K to build, including subdivision. So we've added $300 to $400 of equity there, but we've lost $150,000 of equity as well. So the total of the end value is $1.7 million. And that is the end value of the front house and the back house. The great thing is, this could be in personal names and this could be in a trust structure. When you subdivide, we can do some estate planning with the trust structure on the higher income property. Whereas that front property held in personal names is likely to be closer to negatively geared because it's worth about $700K and rents for about $650 a week. At 80% dent, that's still going to be negatively geared. The great thing in this strategy of doing the subdivision versus the granny flat option is the increased value or the equity. In the granny flat scenario, you're probably not getting, a dollar for dollar uplift. You're spending $250K, you're probably getting $250 to $300,000 uplift in terms of the actual total value of the property. Whereas subdividing, each property has its own title. This front home could be sold to a family, for example, and the back property kept as part of our portfolio, or vice versa. And so what this means, if we've paid $855,000 to begin with, we've lost $150K, but we've spent $620,000. What is the total benefit? So you've got the end value. Let's add up the costs. So you got $855,000 plus the cost to build and subdivide at $620,000. You're all in at $1.475 million, which will leave you with an equity gain of $225,000. So going through this process and spending about $600K to make $200,000 and getting a net yield on the granny flat, or net yield on the dual occupancy in this case, of 7.4%, it depends on your risk profile whether that return is worth it or not. For me, that absolutely sounds like a deal, and this is why I bought this property. I'm excited by the numbers. And so this second option with the dual occupancy really excites me. I look at the numbers and go, okay, I can add a granny flat and it'll give me a boosted yield and it's all on one title. Or I can subdivide, and if I've got the capital, which I can pull together from other properties, or I can potentially pull together through business income, then we can build this dual occupancy and get a massive return and potentially hold this in a trust structure. And I'm gaining equity and I'm gaining cash flow. And the cash flow is actually a lot higher. You can see that net cash flow post the build is positive $20,000 a year. So this is no stress to hold these assets for 20, 25 years, slowly pay down the debt by parking the money in the offset account and build out the asset base from there. Now, this is a massive amount of detail and a lot of work goes into kind of sharing these numbers in detail with you guys. My background is as a chartered accountant, and so the numbers are important, but you might argue over some of those operating expenses or some of those build costs. But the idea of going through this with you is to share through my thought process on the ROI and to give you access to that free investment calculator. So if you got any value out of any of this video, then make sure you drop a like down below. I'd really appreciate it. And if you want to head over to purposeproperty.com.au to book in a free strategy session with myself, if you're looking to buy your own home or an investment here in Southeast Queensland, then make sure you head over to our website. We also have a course there, so you can click on course. That'll walk you through how Emily and I were able to build a $5 million property portfolio on everyday incomes and give you over 3 hours worth of content in a chronological order on building that multi-million-dollar property portfolio. So thanks for sticking around to the end of this video. What do you think about this purchase, our latest investment that we've just made? And if you're interested in seeing a full playlist of me making Brisbane client purchases and sharing some of those addresses with you, then click this playlist over here. Thanks for sticking around. I'll see you in the next one. Peace.